Introduction about stock market. Stock market is an arrangement where equity shares of companies are bought and sold by the participants. The participants can be investors and traders. The investors mainly have a long-term horizon in mind and benefit from capital appreciation over the given period. Traders, however, earn profits by tapping into small price changes in equity shares, which mostly last for a minute to the whole trading session. In India, the Bombay Stock Exchange (BSE) and National Stock Exchange (NSE) are the major platforms where most of the stock trading happens. Here, the buyers and sellers place orders through brokers who use online trading services. The settlement cycle follows the T plus 2 format. In this, the trades are executed on day 1 and the participants receive their shares sale proceeds after 2 working days from day 1. In India, the regulatory body for stock exchange is SEBI, that is Securities and Exchange Board of India. We will see some important terminologies used in stock market. NSE, National Stock Exchange, is the index of the top 50 stocks from the 23 different industries listed in NSE. It can be used to understand the movement of NSE, BSE, Bombay Stock Exchange. Sensex is an index of BSE. Sensex is the average of the movement of the top 30 companies listed in the BSE. The word Sensex is derived from two words, sensitive and index. Bullish market. When the market is uptrend, the prices are expected to rally. Then it is called as bullish market. Bearish market. When the market is in downtrend and the prices are expected to fall, then it is called as bearish market. Index. The stock index or stock market index is the measurement of the value of the section of the market. Generally, it is computed with the help of definite sample size. For Nifty, it is the average of 50 stocks, and for Sensex, it is the average of 30 stocks. This index is used by many traders to buy and sell stocks and also predict the direction of the market. IPO, an initial public offering or stock market launch, is a type of public offering where shares of stock in a company sold to the general public on a securities exchange like NSE, BSE for the first time. Primary market. The new shares IPO are issued in primary market. Once issued, they are listed in secondary market. It is not possible to trade in primary market. After listing in secondary market, the trading takes place on those shares. Secondary market. Secondary market is nothing but share market. Buying and selling of shares in the secondary market means buying and selling of shares in stock market. Day trading or intraday. Intraday trading means the buying and selling of stocks happens in one single day. Delivery trading. Delivery trading is a type of trading where the trader or investor hold the share beyond one day. Demat account. In India, shares and securities are held electronically in a dematerialized format. Instead of the investor taking physical possession of certificates, a demat account is opened by the investor by registering with an investment broker. Shareholder will have a demat account for the purpose of transacting shares. NSDL National Securities Depository Limited. CSDL Central Depository Services Limited. In India, there are two depositories which take care of securities dematerialization. Equity stocks. It generally refers to buying and holding of shares of a company on a stock market by individuals, firms in anticipation of income from dividends and capital gains as the value of the stock rises. Face value. It is also known as par value of the stock. Face value of share is generally 10 rupees. Dividend. Dividend is the payment made by a corporation to its shareholders, usually as a distribution of profits. When a corporation earns a profit or surplus, it can either reinvest it in the business called retained earnings, or it can distribute it to the shareholders. EPS, earning per share. It is the rupee value of earnings per outstanding share of a company's equity stock. PE ratio or price to earning ratio is an equity valuation multiple. It is defined as market price per share divided by annual earnings per share. Shareholders, individuals who buy, in other words, who invest in shares of a company or the owners of the company and are referred to as shareholders. Shareholders usually having voting rights and can participate in management of the company. Volume. Volume is nothing but quantity of shares. Bid. The buying price is called as bid price. Offer. The selling price is called as offer price. Bid quantity. The total number of shares available for buying is called as bid quantity. Offer quantity. The total number of shares available for selling is called as offer quantity. Short selling. First selling and then buying. This only happens in day trading. Is called as short sell or shorting of sell. Transaction. One complete cycle of buying and selling of shares is considered as one transaction. Squaring off. This term is used to complete one transaction. Means if you buy then have to sell means square off. And if you short sell then you have to buy means square off. Limit order. In limit order, the buying and selling price has to be mentioned when the share price comes to that price. Then the order will get executed with the price mentioned by the trader. Market order. When you put buy or sell price at the market rate, then the price get executes at the current rate of market. The market order get immediately executed at the current available price. Stop loss order. As the name indicates, the stop loss are used to stop or limit the losses in the share market. Technical analysis. The stock price prediction based on chart and indicators is called as technical analysis. Technical analysis is irrespective of company's fundamentals. Technical analysis is used for short term, mid term, and also for long term. Fundamental analysis. The stock price prediction based on company's growth fundamentals. The long term investment is done based on fundamental analysis.